Here is the uncomfortable truth nobody on finance TikTok wants to say out loud. The recession dashboard is flashing yellow, and the smart money is already rotating while retail keeps buying the top. Welcome back to Shahrukh FX Crypto. Today we are looking at the late 2026 macro picture and what it actually means if you trade forex, gold or crypto. Let us start with valuations. The Shiller cyclically adjusted price to earnings ratio on the S&P 500 is sitting near levels we have only seen a handful of times in the last 100 years, and historically every one of those zones was followed by below average forward returns over the next decade. That does not mean a crash next Tuesday, it means the cushion is thin. Layer on top of that the concentration problem. A very small group of mega-cap AI names is doing the heavy lifting for the entire index, which means if sentiment on artificial intelligence capex shifts even slightly, the whole tape can wobble. This is exactly the kind of setup institutional desks flag as late cycle. They watch credit spreads quietly widening, they watch the yield curve normalizing after a long inversion, they watch the unemployment rate ticking up off its lows, and they watch defensive sectors like utilities, staples and healthcare quietly outperforming high beta tech on a relative basis. None of these are crash signals on their own, together they tell a story. So how does this hit your charts? For forex, late cycle stress usually means a bid for the dollar in panic windows but weakness when the Federal Reserve is forced to cut faster than expected, which is bullish for euro-dollar on the dovish pivot. For gold, XAUUSD historically loves this environment because real yields fall and central banks keep accumulating, so dips into demand zones get bought aggressively. For crypto, BTC behaves like a high beta risk asset in the first shock and then often decouples once liquidity returns, which is why patient traders wait for the second leg rather than catching the first knife. The play is not to predict a date. The play is to size smaller, widen your stops to respect volatility, journal every macro-driven entry, and stop confusing a bull market in narratives with a bull market in earnings. If this breakdown gave you a sharper edge, drop the word yellow in the comments so I know to do a part 2 on credit spreads and the dollar liquidity cycle next.